Hey, hello everyone, calling the meeting together at starting the meeting at 3:03. We're done. And I do see that we have Jason and Michael online. So we'll go ahead and get going, call the order. First up, election of chairpersons for chairperson, vice chairperson, and secretary. Currently I'm the chair, Mark's the vice chair, and Carol's I think you're the secretary. Yeah. Do we have any nominations?
Very happy.
You seconded it, right, Mark?
I'm sorry.
You seconded that, right?
I'll second it.
Okay. Okay. I have a motion and a second to keep the same slate of candidates. All in favor, say aye.
Aye.
Jason.
Opposed, same sign. Motion carries. Board communications, I have not received anything. Finance director.
Okay.
Great, thanks.
Thank you. Did everyone receive their packet? Oh. Work site, the one I typically would have current order compared to most previous meetings. And then I also did the quarter comparison of fiscal 24 to quarter. For this particular quarter, we are approximately main cash and dividend income of about $2.2 million. Positive also, employer and employee contributions for this quarter were, and total revenues paid for this fiscal year are expenditure side. Expenditures paid $4 million. $2 million over tax. The largest component of this is our value. Administrative costs for PLA auditors were added. This quarter. Return of contributions.
Any questions online?
I was having a hard time hearing. This is Jason. But no questions.
If there are any questions afterwards, please feel free.
We have the minutes for the November 14th, 2024. Would entertain a motion.
So move. Second.
Okay. Do approve the November 14th, 2003 minutes. Motion by Offinger, second by Burbank. Any discussion? If not, all in favor say aye.
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 Motion carries unanimously. Authorization of payments for retirement funds for retirement benefits. As a reminder, we should do this in one motion.
So move, Michael Freeman.
Moved by Freeman, moved by Pratt. Any discussion? All in favor say aye.
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 That's unanimously. That's the ayes.
Good afternoon, everybody.
Hello.
All right, so let's get into this. Oh, by the way, I think Mark needs to be made a presenter or a panelist.
I didn't get that option as, there we go.
Oh, very good. Okay, so I'll go through this rather quickly because I know Mark has a lot of the same material. We usually sync up pretty good with as far as kind of our forecasts and everything else. And just bear with me because there's high winds around here and power has gone out once already. So if I do pop out, that's what happened. I apologize. I'll dial in via phone if that happens. Can everyone hear me okay?
Yes.
Okay, great. All right, so we'll start on the executive summary. I did a little bit of a different view this time. Summary views are listed on the left-hand side. And then you can see your asset allocation, last change we made. And we'll talk about some of those changes when we go through performance. But all in all, there's been a lot going on, obviously, and we're not really sure of what the consequences of everything are going on yet, but I'll try to give you some flavor around some of that. Read through the executive summary at your leisure. You can use some of that for your minutes, but I'll speak to all these points. So we get into, I'll put this in slideshow mode so it's a little bit easier to read. Okay, so generally speaking, the economy is doing pretty well. We're still around that 3% growth rate, which is great. A lot of that's being driven by consumer spending. Obviously, inflation's still there. The latest inflation reading came out just above analyst expectations. So there's definitely inflation there. A lot of it's in food and energy, which obviously impact us the most. But all in all, we had a pretty good year from a GDP growth standpoint. And you can see on this page on the right-hand side, the markets responded to some of that. So large caps, for all the reasons we talked about in all the past meetings, they really have driven the markets higher. A handful of stocks really kind of leading the way higher again. But we did see other areas of the markets that did very well. Small caps, world equity, emerging markets lagged a little bit. A lot of that happened in the fourth quarter. We'll speak to that. Even core fixed income was up. The longer dated bonds you had or longer duration, that was really the only negative asset class that we saw for last year. There's a lot of volatility around rates, and there's still a lot of volatility around rates. High yield bonds, emerging market debt, both added value from an absolute standpoint. And then your inflation-linked bonds and commodities also did pretty good last year. So all in all, it was a very solid 1 year on a calendar year basis. You can see in the fourth quarter, we had a lot of noise going on there, and that's what I'll speak to as we move forward. Any questions just around the general market overview? Okay. Okay, so for U.S. equities, we did see a change in leadership. I think the last meeting we were out here, technologies, when you look at the sectors on the bottom, that was to the far right of this, of all these sectors. That means it underperformed for the quarter. Well, this time technology is back. It's on the left-hand side again, just below communications. So communications, technologies, financials, and consumer discretionaries were the top performers. We have started to see some good growth in some defensive areas like utilities and consumer staples, but they just didn't do well for the quarter. But all in all, they did okay the previous quarter to that. So what's that mean? It means growth outperformed value again. We're seeing growth over 33% there, and then value was just less than half of that as far as returns on a 1 year basis. So pretty impactful. Again, those handful of stocks kind of really leading the way on the U.S. equity side of the markets. From an international standpoint, we did see a lot of sell-off here. And a lot of that can be attributed to what were Trump's tariff plan to some tariffs now today and more tariffs on the way. So we saw emerging markets, international, all sell off. The main contributor to that is tariffs. I would say the secondary contributor was it's been a really cold winter in Europe, as we've noticed on the East Coast. And energy prices are extremely high over there relative to us. So if you think of like kilowatts per, how much you're paying in kilowatts, they're almost triple what we're paying in the United States. It's very, very significant. So their inflation, again, their food and energy inflation is pretty high, but it's much higher than in the US. So we're seeing that the tariffs are definitely creating some noise in the international and emerging market areas of the marketplace. As we move into fixed income, again, a lot has happened here. I mean, the chart doesn't really do it justice because there's small movements on this chart, but there's big moves. So if you go back to 12/31/2023, you can see we had that strong inversion in the yield curve. That's pretty much gone now. So now we're seeing a steepening yield curve. The only rates that are still higher than if you go out to the 2-year or kind of those 1 month, 2 month, 3 month treasuries, they're still hanging above. They're creating a slight inversion. But all in all, the market really looks at that kind of 2-year to 10-year inversion. That's been gone for quite some time. So that's kind of positive news. I guess the bad news in all this, we're still seeing elevated rates across the yield curve. And more recently, we've seen the long end of the yield curve, when you're going out way out 20, 30 years, those rates have been going up the last couple of days. So if you're out that far in the yield curve, you're going to feel pain when that happens, because if you have a 20-year duration bond and it goes up by 1%, well, the value of that bond will go down by 20%. Again, don't hold me to that math, but it's pretty close math. That happens. There's a lot of volatility. The more you go out in the yield curve, it could be beneficial at times, and other times it could be a detriment. So we have a very well-balanced approach to the yield curve. Mark will probably speak to that as well. And we've shortened duration a little bit, but we're staying in between that kind of. Our duration for the overall portfolio right now is probably closer to 4 or 5, where before we had it closer to 6. So we did move down in duration, and that's benefited the plan ever since we made that move.
Yeah, what is your thoughts on what the Fed might do this year? I think everybody's having a hard time trying to figure that out. There's even talk of, potentially even on the board, it's a small probability, but maybe a rate increase based on inflationary pressures. What do you guys think?
I think that's a very difficult question because it's very data dependent, and that's what the Fed's waiting for. They're waiting for the data. So as we move forward here, we are seeing inflation be more stickier than it should. And I didn't even mention this, but tariffs as a whole, and just the tariff plan that's in place today, could be a $1.1 trillion tax increase to the United States. So what does that mean? That means a tax increase to you, me, and everybody else in that room there today. So, that could add up to $800, $900 per household per year. If we start to see inflation kick in like that, the Fed's going to have to step in. There's no doubt about it. So, again, we'll have to see how all these tariffs play out. That's the key here. Is there going to be retaliatory tariffs? We're already starting to see some of that. The Danish want to buy California now, so they're firing back about Greenland. So there's a lot going on in the markets right now. There's a lot of noise out there, but we'll work our way through it. We did in the first administration, and we'll keep a close eye on as we move forward here through this administration.
Thanks.
So we'll pop right into performance. Okay. So this is your fiscal year to date. We've added this, and the next page is for the calendar year last year. So fiscal year to date, you're doing pretty well. You're up 4.7 net of fees. We're outpacing the index slightly there. All in all, everything performed very well. I can tell you on your fiscal year to date, the U.S. equity factor allocation, again, it's a little more defensive. It doesn't have big allocations to the big tech names. It has a lot of allocation to strong fundamental companies, a lot who have not participated in a lot of these rallies. We feel really good about the strategy. That actually outpaced the large cap index pretty significantly on your fiscal year to date basis, which kind of contradicts that other slide that I showed you. But on fiscal year to date basis, it did work out that way. So we'll see how that plays out as we move forward. You can see the noise here on fiscal year to date. International, international specifically was down 1.7%. The US side held up pretty nicely. For fiscal year to date, core fixed income was up 2.19%. You can see we added that limited duration, which we showed on the executive summary. That actually outpaced that by almost 100 basis points. So that's pretty significant because that's 12.2% of your portfolio that outperformed by 100 basis points from where it came from. High yield bonds, emerging market debt, again, very additive on the fixed income side. Both outperformed traditional fixed income, investment grade asset classes. And then real estate's had a really nice, this is more of a REIT scenario, but real estate fund really came back strong. That was up 11.6% on a fiscal year to date basis. So that's not even a full year, and it's done very well. So just, I'll look at the calendars. You can go through this at your leisure. Here's where it kind of flip-flops. So if you look at year to date, the first column, you can see US large cap equities are at 24. US equity factor base was only up about 25. So it closed the gap there a little bit, but that was still additive on a full year basis for the portfolio. And then we saw international had positive returns on a year to date basis. Emerging markets did really well, 11.3%. And then your fixed income here as well. You can see we moved that 12% from core fixed income. You had all core fixed income in this portfolio essentially. And that was extremely additive on a 1 year basis, 330 basis points on a 1 year basis for 12% of your portfolio. So the changes that you adopted, they've worked out really well for you all. And we feel pretty good about how we're positioned right now. There may be a point in time where we want to go back in a little bit more long duration again. I'm not quite ready for that yet, and we'll get Mark's take on that, but I still think there's going to be a lot of volatility on the long end of the yield curve for the next couple of quarters.
Yeah, that might be a 2026 discussion.
Pat, if you're talking, we can't hear you, you're frozen.
Yeah, I think he froze. Maybe it's the wind.
Well, it's pretty close to
Yeah.
I think he was about done.
Yeah, like, that's
Yeah,
what
we'll
the
jump
park,
to you, Mark, and we can always go back for questions.
Yeah, I just don't know if he's got, okay, good. Looks like he stopped sharing.
timing is everything. Time that. Perfect.
You should be able to see my screen. If you're following on the page numbers, it's 46 in the deck. And you know, it's funny. Pat and I generally talk once or twice during the quarter and the prep time. But our materials, our two teams that put the materials together generally kind of arrive at the same place. I think the biggest thing on our deck, you know, the headline numbers are generally pretty good. If you were just to look at the headline numbers, you might think the economy's in great shape, but we kind of have a bearish outlook, and I think Pat kind of hit on some of these things. This slide, apropos of nothing specific, it's more just kind of informational. It just shows a couple different time periods, 1980, 2000, 2020, 2024, and the 10 largest companies in the world at that time. It just shows kind of how, you know, not too long ago, 40 years ago or so, oil and gas dominated, got a little bit more diversified. And then really the last, you know, couple decades, tech has led the way. So it's just amazing to look at how big the biggest company, IBM, was back in 1980, and how big Apple, NVIDIA have gotten in 2024. We talked the last couple of quarters about some of those stocks dominating, back-to-back 20+ returns for US stocks, but you know, we're worried about valuation. So stocks are really pricey, especially these large cap blue chip stocks. And you know, not that they can't go higher if the company continues to do well, you know, they're going to have to earn their way higher. We probably aren't going to get too much help from the Fed, and consumer spending has been good, but we're starting to see some issues there where people are still spending, but they're charging more and they're defaulting on car loans, they're defaulting on credit card. So their ability to keep on spending is kind of being questioned. The unemployment rate right now looks good. It actually came down last week to 4%. But a lot of the biggest creator of jobs was the federal government. And now things are swinging kind of the opposite way, where we're seeing a reduction in federal jobs. So we kind of worried a little bit about that, that unemployment number, and that has a direct effect on consumer spending as well. Interesting, I'll just flip ahead a couple slides, again, a lot of overlap, just showing things in a different way. Fourth quarter was really reversion back to US tech companies. International sold off, bonds were negative. International, almost 8% losses outside the US. But surprisingly, this year, so far, we're only 6 weeks into 2025, but international has outperformed the US by just a couple hundred basis points in the developed world. So maybe something to keep an eye on, despite the tariffs and the stronger dollar. Maybe international could see a little bit of a renaissance. The US has really dominated over the last decade or so. And I think big question, I'm asking everybody what they think about interest rates. It's really difficult. Prior years, people would have predictions that didn't always come true, but the market would price in 2 or 3 or 4 cuts from the Fed. I think that's really on hold to see what some of the policy looks like and what the effects of tariffs could have. I think the range is anywhere between 1 increase or 2 decreases in the federal funds rate. I think it's just going to be all about the data, as Pat said. So very similar outlook. I think we're basically reporting on some very good numbers from last year, but kind of all of those numbers being questioned a little bit as we head into the middle part of 2025. So again, our main job is not that, we don't, the numbers, the proof's in the pudding. Pat, quarter after quarter kind of rolls out really strong performance. We've been impressed with the fund lineup that's in there. Our role as a registered investment advisor is to put another set of eyes on it. So we have a proprietary scoring system where we look at 9 criteria, includes performance and risk and consistency and expenses. And really, these are the actively managed funds in the plan. The scores remain excellent. We have a kind of an abnormal score for the emerging market debt, which I'll touch upon. But the other 5 active funds are all right around top quartile. A couple are top decile, meaning they're better than 75 to 90% of their competition. So if we look at the limited duration bond, we compare that to all of its peers. We score them, basically a report card, 9 different criteria, and then an overall score of 25. So this means that the SEI fund is better than 75% of their competition based on our metrics. The emerging market debt is really the score. We can kind of throw it out the window a little bit. Our analysis on it, when we look at it versus its benchmark, it performs really well. It's a strange category, and our database doesn't really capture the category correctly. The emerging market's small piece of the portfolio. It's just used as a diversifier with our US bonds, but it includes emerging markets, hard currency and soft currency. The category that we pull from Morningstar really just looks at hard currency, which is kind of daily traded, stable currency. But there is a portion of that portfolio that is softer currency, which is a little bit more stable, unstable, fluctuates a little bit more. So it's a really small subset, and it's really not tracking that one perfectly. So we are totally comfortable with this fund. We put it in a few years ago. It's been additive to the portfolio. Everything else continues to score really well. We haven't had anything that's even drifted up to 3rd quartile, which we would be, have some issues with, and potentially we'd look at alternative funds if that were the case over a long period of time. But just to reiterate, we're happy with the portfolio. They've done a great job with the underlying managers of the portfolios, and no recommendations from SageView for any types of changes to the portfolio at this point.
I don't have a question. question if I could?
Oh, is there a question?
Yes,
Oh, sorry.
I don't understand cryptocurrency, and I'm sure it's not a part of our portfolio, but does it have any effect on our portfolio, this thing that everybody's talking about? I
Yeah.
don't even know.
There is no crypto exposure within this portfolio. And I don't think it's a discussion, Pat. I don't know if, my guess is that it's not a discussion that's being weighed for your clients' portfolios. You're on mute if you.
I'm here. I'm sorry. I clicked a button to become a panelist and it paused me for a minute. I did hear the question. Yeah, currently there's no crypto in the portfolio. We don't really think there's a place for it at this point in time, maybe in the future. Again, there's a lot of volatility around crypto, and probably the last thing we want to do is have a good chunk of allocation to that, and we see Bitcoin go down 20%. So we think you're very well allocated. We know it's a big topic. If you go back to the executive summary, I even put a little note in there about Bitcoin. Maybe that's why the question came up. But it's definitely a big topic and something we're evaluating, but we don't believe there's a place for it in the pension portfolio at this point in time.
It's highly speculative. It's hard to price, unlike other, more traditional asset classes that the portfolio uses.
Well, I'm not recommending it. I just am trying to understand it.
Yeah, me too.
any other questions?
I relate it more towards kind of like oil, right? Oil has a lot more speculation around it than a more traditional asset class, right? So if you buy a fund with oil companies in it, you know exactly what you have. But when you buy oil, that price of that oil can change on a lot of factors. And that's kind of what Bitcoin is today.
Thank you.
Thank you. Any other questions? Appreciate it.
Thank you.
And if you can take yourself off share.
Oh, yes, sorry. I think I'm off.
Not yet.
Am I off? That's the question. Are you still seeing my screen?
Just switch.
Yeah, I think it's on the bottom. If you expand the whole Zoom, you can see just stop share.
Okay, bear with me. Why do I feel like I've done this prior meetings? All right, I'm gonna log off and log back in.
I think I've just replaced you anyways. I think you're okay now.
Okay, good. Sorry about that.
All right. All right, well, can we just jump in?
Yes, please. Go ahead and introduce yourself.
All right, and Steph Scurd, the actuary that manages the pension plan, help their costs and manage what to do with it. I will start off the same kind of the liability side. These guys always focus on the investment side. On the liability side, we don't have as much noise you get from the current administration and the policies. I mean, you may get on the asset side, you wouldn't have changes in the assets and whether they go up or down could affect your contributions. But strictly speaking, on the liability side, you don't have a lot of the volatility due to policy decisions that the government makes. Right? It's really based on the participants, what they do. Whether they decide to leave the town early, whether it's through retirement or even outright terminating, or do they stay longer, right? There's other things you control is compensation, right? That's a driver of what your costs are, things like that. And the biggest assumption would be the discount rate. So, a lot of that will collect, get annual rates. So with that, we're kind of talking about what's the purpose of the valuation. Kind of think about it. If the purpose is really kind of act as a tool. It's a tool to come up with some way to allocate costs on a yearly basis, budgeting purposes, right? The town wants to kind of know how to fund this. You want to have enough money set aside for what that do. So we kind of use evaluation as a tool for that, right? It's cost that they have to cover. They have to cover the benefit payments that they are promised, right? benefits to purposes that work for the town when they get to retire. So you want to cover the benefit payment. Obviously, any expenses that are going to incur from this, they're offset by employee contributions. That's kind of a fixed number of what you have employees pay based on their negotiation. And then investment return, right? So we kind of want investment return to be as strong as possible because that offsets the tax costs. Again, the valuation, like I said, is a tool. In that tool, we come up with what we call actual employer contribution. And what that is, that's kind of the annual basis what you're budgeting for a fiscal year, given fiscal year. So that what we call that ADAC for short, consists of two parts. One of the bigger ones currently for you guys is the amortization payment, amortization unfunded liability. That means that the liabilities and benefits earned are greater than the assets you guys have already set aside. So you have some shortfall that amortize that over a period of time. Currently, it's we do layered amortization, so it's over 15 to 20 years. And we will see that later. The second component is the benefits earned on an annual basis. Those benefits are earned by the active population, what those people are earning in a given year. So that's the second component. So the next slide will kind of touch on the highlights on that. But some of the things that happen. First bullet is the market value of the base. The assets are 12%, over 12.1%. That's been a strong year. Let me kind of circumvent that. Always remember, like Patrick and Mark, they talked about current assets, right? The current quarter. Remember, this is a snapshot, really capturing where your assets were at June 30th, 2024. And then we're budgeting for the 25, 26. So things are kind of, we're looking a little bit in the past on the asset and liability side measure for what we're going to budget for upcoming fiscal year. Always bring that back because they're always a little ahead of us, and then we kind of make you guys think in the past a little from where the assets were at that point. That was kind of a strong year. The fall, mostly in the last 6 months of the 2024, pretty strong, except for December. For what we were talking about. Next is couple of the assumptions changes. Mortality, we haven't changed that yet. There hasn't been any new tables yet for the improvement scale. So we're holding that. Expect that to change. They're talking about these some new mortality tables for the public sector. Remember, they came back out in 14. But they finally updated them again. There's a slow due to the impact of COVID. They try to really quantify that. That's been a little bit of a struggle. Next assumption that we kind of kept the same was the inflation assumption. We kind of look at long-term inflation. Obviously, the last couple of years you had that high impact inflation, but we look at long-term. Use the Social Security's Trustees annual report. That's remained at 2.4% for the last 4 years or so. Yeah, that's like over 70 years, not just that. We're through. So what the underlying that is the investment return assumption. Yeah, it's just keeping that 16 3/4. There's been a lot of volatility around inflation, what's going on in the market. Years ago, everything with capital market assumptions were high, saying you could probably utilize a rate of 7.5%, 8%. There's been pauses, obviously, they're trying to get inflation back down. They really want to see what's going to happen here before we kind of start to move. So still, I think that the sweet spot is probably still a 6.25 to 6.3. You're at the top of that range, so I think you're all set. No reason to really change that unless you want to be ultra conservative. That's always the tougher thing because you have to take a budget up. Next bullet is losses. The plan did pretty well, made about 0.6% on liability losses. That's due to changes in retirement, salaries, mortality. But again, you probably have some losses, some gains in there, but grand scheme of things, you only had a minor loss. All that kind of the things I've already mentioned was that transpired. Big number that we probably stop here, and this is all you really care about is the numbers. This year's budget is 6.75%. That went up a couple $100,000 from 6.5% for the fiscal year at 5. Go to the kind of rise that a little bit. Funded ratio stayed pretty consistent, 78.5 for the town. Board of Ed is 85. Most towns, when they have a board of Ed and town combined, they just kind of allocate assets based on liability. And everybody's still funded the same way. Your plan's funded 80%, everybody's funded 80%. But you guys kind of divvy up and really kind of track assets by each union. A little more work, but accurate what each last one is just to mention that we only have just under $500,000 of unrecognized gains. If you remember last year, we probably had losses of, I don't know, 4.5 million or something, pretty big number. We had another strong year, kind of wiped out those unrecognized gains. You have very little bit of gains or losses. That means your actual value of assets is really close to your market value. Kind of all back at the same.
The ADAC or ADAC,
Yeah.
is that the same as the contribution?
If that's what they're gonna put in their budget for 25, 26.
And,
So right now, they're paying the 6.8.
so should we feel bad having to have an increase in?
Well, if you think of it this way, if,
In other words, like if we're doing our job really well, that should go down.
yes and no, right? Because your plan is open, so there's different things, right? So if your population grows, right, normally you expect to
So
continue.
they
to
did a
grow.
lot of hiring 20 years ago, whatever, right? People are coming due.
Yeah. Well, when we switch to the next slide, we'll kind of start to kind of feel what's going on. So this is your liabilities, a snapshot of your liabilities. So the first back box has the inactives that you see 121 million for retirees, and only 6 million for term vested. So the retirees are the ones that pay that. You have just over 61 million for active, right? So again, that's less than a third of your population to continue active, right? So you have more retirees, so that retiree liability went up from 112 to 121. So you have some growth there. The active liability actually went down 65 to 61. So that tells you that, yes, more of your population, more of your liability lies in people who've already earned benefits. You're kind of still catching up some of that unfunded liability. But realistically, I mean, you had 149 million set aside for those guys already, which more than covers that. But so now you're closing the gap with the active. So it's a matter of how you look at it. You're paying for the actives each year.
So the total actuarial accrued liability is outside of our control.
Correct. Yeah,
That's
what
the thing.
we're measuring.
That's what we have to hit. That's the problem we
Yes.
have to solve.
Yes. So
And the fact that the number went up from 183 to 188. I looked at the ratio of that number versus the ratio of the unaccrued liability. I guess as long as we're
you actually went up
better
a couple percent. So you're really flat. It's 78.7 to 79. So you went up 0.3%. You improved your funding by 0.3. So again, we'll get into the components that make up that ADEC and what's driving it, what drove that change from year over year. We jump to the next slide. So we'll kind of see. So here's the amortization. So there's two ways. Because you have an open plan, we do the layered amortization, right? So remember, we set whatever that funding was back in 20, which was that 30 million number. That's the number you're trying to get over the next 20 years. Close that. And once that was done, you're going to have each sliver that occurs each year. And one of those, there could be a year where your unfunded goes the other way and you get a credit. So you're always going to have a piece of that, unless you wanted to do a closed amortization, which would be, we would do that for a closed plan, if you want to have the benefits all paid off. But with an open amortization, people that are still working, you're kind of assigning that unfunded piece to them, so you're paying for that over their life. Still haven't gotten your clear answer for you, but we'll kind of get to that. Because I think you kind of need to see the pieces. I can see why. This is just a quick snapshot of how the assets have changed. You have the numbers both on a market and actual basis. Market value basis is what you measure for your financial footnotes, what numbers that go in your CAFR. So that's kind of a market. Looking at it, the actual value is used for a funding basis. That means that's how you determine what your contribution and how you fund the plan. You can see, you got about 7.4 million in contributions between the town and employees. You're paying out a little over 12 million. So you have kind of a little bit of a negative cash flow that you're made up closing that gap by your investment. Obviously, you have a strong year, pretty much on both. So you did close the gap a little. Next slide. We don't have to really get too much detail, but you can see the bottom block is those gains and losses that are recognized here. I mentioned that 477,000. Shows you how we developed that. But you don't really want to know that yet, so we'll keep moving on so we can kind of get to the components of yours. Rates of return. You can come back to this because showing actual versus market. You can see actual is more smooth. This is actually the funding level. So in this year, they're kind of the same. We'll focus on the funding level, right? Why we have an actual smooth asset, right? Which is in the darker blue as opposed to the. So you can see that blue is higher. The funding level is higher for almost every year except 21 when we had a huge market run up. So by doing an actual value, using the actual value of assets, you kind of look a little better for funding purposes, as opposed to if we were snapshotting it for financial footnotes. If you look at, 22, it would have looked really bad on your financial statement.
What's the right interpretation of the actuarial value, the slope of that curve?
That's on a funding basis. That's just because liabilities are growing faster than assets.
Right, that's not good.
That is not good, technically not good. You're in a good spot. You're right hovering around 80%.
So on an absolute basis, we're okay,
Yes.
but the trend.
Short term, it doesn't, some of it might raise it. Now, if it dropped quite a bit consistently, so the last couple of years is really because you're still recognizing those losses. Right? And that's kind of what pulled it down. And you saw in 21, it went up. Then it went, 22 was, as big as that 21 jump, it went down 22. Even it actually pulled it down even further in 22.
I'm comparing this, I'm involved in another thing where our pension line, all has been improving.
Yes.
Because the market's.
Yeah. Well, I would say they probably had a less amount of assets. So when you have a bigger bucket of assets, when you lose, it has a bigger hit, right? So if you didn't, this is $148 million plus, right? Now, if you had 5 or 6 million, 10 million, that huge drop wouldn't be as impactful as it is on a bigger point. It takes longer, right? It's easier to go up, right? You go down, you take a big chunk. When it goes down, it takes a little longer to take that. And it's a scale of so to speak. Go on. I think the next one's just this experience just showing where it changes in the liability. We expected unfunded to be 38 million, actually 39. And towards the bottom, it showed some of the sources of the gain loss. Assets 163, salaries down. So your salaries went up more than expected. That's kind of a sizable loss. Offset by retired mortality. I think more people passed away and no longer like the benefits. So demographic, like I said, you have lots of pluses and minuses. But a grand scheme of things, 1.2 million on 160 million is really small. Now, if you have gains and losses in the 5 to 10% range, we build this up to see something right? But 0.6, I think last year was 0.1. It's been relatively small, so or something. The next one should be the contribution. So this is kind of where you start to see the change, right? If we look at just the top box, the normal cost, right? So the town normal cost went from 3.9 million to just under 4 million. That's really the population. So you expect your normal cost to go up because pay goes up. Right? If you have the same body of people, you expect it to continue to grow as benefits continue to grow. Kind of like, cost of things keep going up. Nothing really goes down. It always goes up. Right? Value of a household continues to go up. Likewise, your normal cost goes up if everything's so that piece of your normal cost went from 2.5 to 2.6. That's part of it. That unfunded amortization piece went just under 3.7 to 3.85. So that's the other piece. That's the additional liability that you're in. So that gives us, 6.5 to 6.75. Next slide is probably the one that's going to show you the most where the changes occurred, right, from what it was last year to this year. So what's driving that change? The biggest number is that 262, the new entrance. So you had it. So if we just ignore the new entrance on the continuing population, we really would only get the growth. We expect some of them to terminate to retire, but we expect their salaries to go up. So you have like a small increase in their expected cost. But new entrants come in, so that's a whole nother bucket of cost that's now being earned for that year. Right? They don't have any past service liability, but they have. So that's the biggest change. Liability losses, the biggest one being salary increases that happen there. There's a couple of tweaks to the plan provisions. Assets, loss of assets only 14,000. The other sources kind of catch differences in benefits paid, differences in expenses, data changes that may have been. Overall, that kind of gives you that change with a feel for how the components work. So what I would say the biggest change is active population. That got replaced. You had 44 new entrants. We're at, now we're getting a normal cost that didn't have it before. I also have 4 retirees, which I think is the next slide, possibly. Let's just show the contribution. Just touch quickly, the bottom blue, the brighter blue is your normal cost. That steel blue on top is the past service cost. We kind of want that to shrink, but that's just saying, funded liabilities growing faster. Again, ideally, you want that to be as small as possible, and we're only funding for benefits being earned. We can skip those. Those are more for internal purposes. I don't think you guys are concerned by the groups and what they're doing. So this kind of shows you, as I was talking about the population, why the liability is up. So if you all the way to the right, the total column, you had 754 participants. Last year, now you have 767. Again, we saw the liability for the inactives go up. You had 339 retirees, now 355. That was the biggest change. Actives did go down, but salaries went up, and then you have a lot of new bodies as well. So you have all that liability has been replaced, that left. So and you have more retirees now. The way to shorten your amortization period, just say you have flat 20 years, then you would expect it to grow, close that gap more and more, but it could make your contribution bigger because you do have an open plan. Again, that suffice for your answer yet?
Yeah.
I mean, it's not a one simple answer.
Right, so in simple terms, town hires more people. It increases the line.
It certainly, if less people left, for sure. If nobody left, then yes, it has to be.
And they end the year with more employees, liability.
And sometimes it's not as simple as that because person per person, right? You have someone
Higher
dies,
person and
Yes.
higher wage person.
age has a big
All
impact.
things being equal.
Yeah.
All those people are equal. More people equals
More
higher.
dollars.
Our job is to do our best to ensure that the proportionate contribution that it takes to fund that liability is as low as possible because we've done a good job managing the assets to offset the increase, right? And I'm looking at these numbers and saying we've done an okay job because the increase is lower proportionately than the increase that the town's contribution is growing at a slower rate than the employment.
So what's happening? Yeah, it's growing a little faster, right?
Is it growing? Contribution is growing faster than the.
The contribution is continuing growing because your population is right. So is it proportionally? I mean, what we would do would look at
Too
the cost.
complicated.
We would look at typically we would look at the normal cost and say what's the cost per person.
Yeah.
So you take that normal cost and divide it by 361. That would give you the cost per active person. You can look at it different ways. So if we go back to 5 slides, I think, where we did develop the ADEC. So here you can look at it as a percentage of payroll, right? And the way some towns would budget on that way, that basis. You can kind of see, I mean, year over year, it's pretty much consistent, right? Your costs are, 9.1 and 9.2, your normal costs grew a little bit, and that's because salaries were a little higher than expected. So that's a big driver, right, on an annual basis of that portion of your ongoing budget number. Now, what would make it go the other way? All right, pay raises aren't as much as we expect them to be. People, you have more people that die than survive. That's going to help you. People terminate with unvested benefits. Those are the things that will lower the liability. Help the liability. Again, when you have people living longer and get paid more than expected, that's
That's right, the COLA for retirees.
Like everybody said, we're in the ballpark.
Yeah, I mean, you're around 80%. I mean, you know, anybody that's in that 80%. So if we go towards this last couple, so you want to see kind of your peers. So what we take, I'll put that, we'll just, before we get to that, the decisions, hold on next. Okay, hold on. So this is like one-stop shopping, I always say. You look at, you don't want to look at that report, entire report. This kind of summarizes everything for you. It has, you know, it's year over year, so it has all your participants, payroll. Next in the middle there is the liability, so you can see how it's changed over your assets, unfunded, and your ADEX on the bottom. So it's just, it's, you know, it has all the information. Wanted to point that out before we just keep around too much. Next slide is just some thoughts. You know, always being able to look at that 16 3/4 assumptions, higher mortality. If we think the assumption of doing, you know, typically you want to do an experience study every 3 to 5 years with best practices, then probably 10. So, right, just keep throwing that, get that into your back of your head. I mean, our assumptions are probably, you know, experience study say, oh, we don't have to change anything, everything's right where it should be. But best practices, sometimes you understand that. We want to make sure we look at. Historically,
When have we done the last experience?
I think it was like maybe 2014. I have to, it should be in the back of the report. It even says last experience study was, you know, went under some of the assumptions.
And what is the experience?
So it basically looks, you look at actual experience versus expected. So you look at actual deaths, mortality, retirements, salary scale, and you look at it over 5 to 10 years period, you know, to see what the town, right? Hopefully kind of throws a little, some of that stuff off. The retirement patterns could have changed. Salaries could have changed because, right, everybody might have froze salaries during 2021. And then in 22 or 23, all of a sudden you could have had 2 or 3 years of pay increases. So some of that can be stored, so you can kind of look at over a longer period, see if you're right. Like I said, our gain loss experiences tell us certainly the last couple of years, we're pretty good on that. But I just like to point that out because it is one of the best. Follow those kind of things. The next 2 slides comes from CAFRs. So the first one kind of shows you where the discount rate is. Again, it's slowed down. Remember, these are values from 21, 22. And 23, I expect 23 and 24 values. I expect this slide to really be very few plans are probably moving down or moving anywhere because of the impact of inflation that would have occurred in 23 and 24 valuations. The next slide kind of shows you the comparison to funding. If you guys are 80%, you can see there's a lot of plans. And what's worse than you got 80% is a good chunk of plans are 23 years in blue, and everybody kind of moved up more or less from 22. We had another strong year in 23. I expect it to continue in 24 because 24 was another strong year. So 23 and 24 were 2 strong years. You're going to measure 22. Kind of so when you're up at 80%, yeah, you want to be in that 90 or everybody wants to be 100%. But then when you're 100% funded, it does create other issues. When you're really fully funded, then towns like to take that constitution holiday, and you don't want to. You always want to make sure you're at least putting in the cost, right? Because otherwise, someone else has paid for the benefits earned for that group. Kind of like how on the flip side, you look at all the plans that are unfunded. They're unfunded because they took contributions. So you're not there yet to worry about that. But one of those is kind of a catch-22 when you become fully funded. How do you handle that? You may not have a required contribution, but you may want to put it at the minimum. The benefits being earned. Did we get to the heart of your okay?
I think so. If we look at our performance on a percentile basis, last year, we've gone up with that.
So you went up slightly, right? Because if the funded ratio went from 79.
Now, compared to our peers.
Your peers,
It looks like a lot of folks from,
I would
22 to
assume
23.
most people moved in the same direction.
but a lot of people moved up into the 80 to 80.
Yeah.
And
Yes.
we're still 70 to 80.
Yep.
So our performance relative to peers has probably gone down.
You have to think when you kind of want to look at specific peers.
I'm just looking at this table.
Yeah.
Right? I just look
Yep.
if I look at the numbers here, these are truly our peers.
Well, this is all the 165 municipalities in the state of Connecticut.
Yeah.
So that somewhere there's your specific views. And, some plans could have done better on assets, some. I think most were at 10 to 15. Better way to look at it is when you look at the gas, look at the gas report where 12.1. So if I look at all of them, what they earn, like I said, they're all at 10 to 15. What's different, you can't always tell the assets, the rates of return are fine, but you can't tell compared to your peers, the liabilities grow, right? Because there are a lot of towns that are closed, new entrants. Realistically, they should be getting better funded than they're insuring. So the ones that are still open are probably similar to you and paying level or change one. Stonington, they went down. Again, it has to do with your population, how your population. So you would want to look at only open plans, really compare apples to apples.
Any other questions?
I have a quick question. This is Pat. And thank you for that presentation. It was very insightful. So when you look at those peers, I guess the question I have is, you guys have reduced your actuarial assumption rate over the last couple of years. Obviously, that has an impact on the liabilities. How does that have you looked at other municipalities? Where is Town of Groton versus them with regards to the actuarial assumption rate? And obviously, that does have an impact in those groups, correct?
Yeah, so again, you're going to have, based on the type of plan, whether it's open or closed. So closed plans definitely might be more conservative and getting lower. Stonington 6.375. So I do have other ones. Again, when you start monkeying around with the investment return assumption, it could be due to budgeting. So if a town has pressure where it's going to be fiscally unattainable, they might hold a higher rate. I have towns that are over 7, that's dropping this year to 7% or closer to 7. I mean, if you want to look at peers, most of them are, like I said, at 6.25 to 6.75. A lot of them have gotten down to 6.5. Again, so it's a matter of when you do make that drop, and I think we just did it a couple of 2 or 3 years ago. You have to be able to absorb that, right? And
Yep.
What's put a pause in everything, as you can tell, is that high inflation over the last 2 years. Right? But finally, you can start to finally justify those higher rates, but everybody's like, we're not going to jump on that bandwagon. It's taken a lot of hard work to get plans to where that long-term rate. You think you're going to earn 7.5% over the next 20 years? Hard to say. Most of them not.
Yeah.
You probably see plenty of them, but most of them do not. We do show like the last 10-year average in the report. You can see where you're at. Most of them are probably in that 7 range. You might have a few outliers that quarter closer at 6 and 7 over 10.
Most you've seen. Thank you.
I look at it when I do it, and I don't, unless someone asks me to put all that down, it'll start. Because what are you asking? What have I seen over the last 8 years?
Just right now, what's the latest work with it? Just curiosity, what are the lowest you've seen?
Over 10 years, it could be 5%. But again, remember that.
I mean, their assumption though for moving forward, whereas we're at the 6.75.
Yeah.
18 months down to 5.
Anybody that's going to be down in the 6 around the 6 is tended to be the ones that are closed and are very mature. So maybe they have no active. So when you get to that, you're going to start. If you have a closed plan and all you have is retirees left, you're not going to be in the equity market. You're going to be in the fixed income market. So based on your asset allocation, you're not going to be able to support a rate that high.
So I'm telling you, if we were magical, we would, and I know this is super, if we were magical, and we did such a great job, the town wouldn't have to contribute.
That's the goal for next year.
There's a handful of towns that are like that, but not.
Yeah, well, we're not magical.
Yeah.
And if we're not quite magical, we would say, well, you're not having to increase year over year. But we're saying that you have to increase. And so somebody could say, well, oh, that's because you're not doing your job, because you, all of a sudden you're having to increase. Right? Because if you were better,
Yeah.
you wouldn't have to, the town wouldn't have to throw any more money. And our response to that would be, yeah, well, you guys hired more employees. You have an open plan, so more people came onto it. So we've got to fund those. And if we were doing a really bad job, that increase would have been even higher than.
Yes.
Right?
Yeah.
That's the way I'm thinking about it.
Absolutely. I mean, yeah, if you don't hire, if your plan stays the
It's
same
not
body.
your fault.
Yeah, if you have the same body of people, you know, yes, over year over year, the investment return, a higher investment return should lower that. Again, if all the assumptions are assumed, are that, and the only one that outperforms is investment return, we will make gains on it. Again, because you have so many different things, people live in longer expected, people get higher pay rate. So next year, maybe they don't get a
Again, it's
raise.
not our fault. It's right, somebody.
You can be there.
Bernice doesn't hire.
Those people, those people just stop.
You're paying people too much.
I'm sorry if I asked.
What I've seen here, I see with a lot of towns. A lot of towns did have higher increases in salary. I just did one presentation earlier this week where this increase was about 4.3, 4.5%. They did like 7%.
Well, I've seen a lot of salaries across every job in the country. Finance inflation. COVID, everybody had to raise wages.
I don't know, I'm in the private sector so much.
Big number.
Go to Chick-fil-A.
Okay, thank you.
Hopefully next year we'll get better news, you know. You guys keep doing a great job on the investment side. Next 6 months, doing well. Yeah, everything's unpredictable. You know, things change. The problem with assets is you could have a great 11 months and 1 month can throw things off. And you don't want that 1 month to be in June for us, because that's what we measure your liability, your assets. So, you know, you can have a bad month now and then be covered by June. That's fine. We look at a snapshot. They're looking at quarterly, monthly, and all that. They have more.
Great, thank you, appreciate it, the information. Okay, on to other business, does anybody have anything else to say? The next meeting will be May 8th. All of that? Yeah. Oh, sorry, yeah, you told that beforehand, we did a vote to, is it just to accept or
Accept
and
and
file? We need a motion to accept and file. Sorry about that.
Okay.
Okay. Is there any discussion? All fair say aye.
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 Opposed, same side. Motion carries. Thank you. I entertain a motion to adjourn.
I so move.
Second.
Second, Michael Freeman.
Thank you. All fair say aye.
Aye.
Thank you very much. We adjourned at 4:06.
I said it earlier this week. I think she's. Oh, I can't.
Hi, everyone.
Want to learn about